Welcome to the weekly update, where I'll go over the action in the market for the week of September 8th through the 12th, and we'll see how things look for the week of September 15th through the 19th. In spite of everything that's happening, and there's a lot happening right now, it's not having a real direct impact on the stock market, at least yet. We have geopolitical things, there's domestic things happening in the US, but at the same time, even though the market is looking positive, you have a lot of people that don't really think the market should be going up, and that's probably why it has been going up. We're seeing sentiment pretty much still at neutral, at least with the gauges that I follow the closest, and so we're looking pretty positive right now. One thing to be aware of, the Fed will be coming out in the upcoming week. They're probably going to cut interest rates by 1/4% or 25 basis points. The market's been kind of building up in anticipation of that. Are we going to see a buy the rumor, sell the news type of scenario unfold? That can happen a lot of times ahead of earnings when companies come out and the stock goes up, and then the earnings report comes out, it blows everybody away, everybody likes it, and the stock goes down. Not saying that's what's going to happen, but be aware of that. We always have to take the three sides at the same time. Market can go up, it can go down, it can go sideways. And we've been seeing a lot of sideways action, especially in Friday's session, but for the most part, we're holding on to gains. We're looking pretty positive. There's always things to worry about, though, as we go through the charts. So, going back over this week's session, for the week, we were up 1.59%, and we were above average with volume. And for most of the trading days, we were pretty healthy with volume. So we're seeing that picking up again. After Labor Day, we didn't really see a big pickup in volume, but now we're starting to see that creeping back in. We are positive and looking pretty good from a bigger picture perspective when we go through our charts. And inflation doesn't seem to be a real concern to the markets right now. Interest rates have been really coming down. They went up on Friday, but we're dropping down with the 10-year yield, and that's more market friendly. We also have the dollar, which continues to be in a downtrend, and that's helping stocks to go up as well. And of course, even though the market's not really being impacted by this, there's all these geopolitical things going on. The Russia-Ukraine, things going on in the Middle East, things that could at some point come in and have an impact, but that doesn't seem to be a big thing, at least at this point. But that can always change. And Fed speak has pretty much been limited now. They have a blackout period before their Fed meetings, and they can't come out and make their grand speeches and say what they're going to do. Okay, as far as our trend, we're still not trending on the weekly charts, but we're positive. The green line is still above the red line. We're starting to see a trend again on the daily side, both in the short and intermediate term, and those trends are also positive. So we'll see if the market's able to really break out and to the upside and start to establish a trend. So going over the week, the Dow was up 1%. It set all-time highs this past week. The S&P was up 1.6%. We had the NASDAQ up 2%, setting a new all-time high. The NASDAQ 100 set new all-time highs. And even though the S&P was down on Friday, the NASDAQ and NASDAQ 100 were up and they set new highs. Seeing a little bit of a lagging back now. The small caps, they had a few days there that were looking pretty good. They're starting to underperform again, along with the mid caps as well. So just some bullet points. It was a pretty broad base week with advances, but really it was the mega caps that helped things to advance. Tech, also, that's the main growth area. It helped have the market go higher, and semiconductors are improving. They're not really taking a strong leadership role right now, but they're trying to break out to new highs, but they're not really outperforming the tech sector. And because all this AI related enthusiasm that's going on, and then company by company, there is news that comes out, and most of that has been taken as positive, including this Oracle, which is not one of the Magnificent Seven stocks. It might become one. We might have the Magnificent Eight if they continue to grow, but they were up 25.5% for the week. And they came out with a report about their AI cloud, and it was very well received. They're a big database company, and so that really helped to keep things a little bit more positive. And then Tesla was up 12.9%, Broadcom up 7.5%. When you get these types of things happening, that's when the indexes go up. And economic data that's been coming out, it's reinforcing this idea. Yeah, the Fed, they're going to cut rates. And they really should do that because that's what the market says they should do. And as I say over and over again, it's the Fed should be following the market, not the market following the Fed. We can listen to what they say, but in theory anyway, they should be following what the market is telling them. I know reality is quite often different, especially since the great financial crisis. It seems like the Fed has come in. They've always been important, but they've taken more of a leadership role rather than a supportive role in the whole stock market. Then PPI, that was a report a month ago that freaked out the markets. It came in a lot stronger than expected. We did get PPI this past week, and it was a little bit stronger than expected. But then we also had CPI came out, and that came out as expected, the core CPI, the inflation component. And then we have initial jobless claims. Now, the continuing claims are going sideways in a higher range, but the initial claims, people getting unemployed for the first time, that really jumped. And you take all of this together, and that reinforces the idea that the Fed's going to come in and cut rates. What we're trying to do here is keep track of what is the context as to why the Fed is cutting rates. If they're seeing a little bit of weakness coming into the economy and they want to cut rates to try to tweak things up a little bit, that could be positive. And as I say over and over, if they're coming in and cutting rates because the economy is falling apart, that doesn't matter. The stock market is still going to be under pressure anyway. So we need to know the context behind these rate cuts. And overall, you had leadership from tech encouraging rate cut expectations, corporate news. It allowed the S&P, NASDAQ 100, and Dow to set all record highs over the past week. The S&P set that on Thursday. It was down a little bit on Friday. And even though there are some areas of weakness that are going through the market currently. So I show this every week. We're still down in the lower end of this dark blue bar here, or dark blue line, I should say, that inflation it's stayed down here for quite a while now, but we're just not getting down to that 2% level that the Fed wants to get to, but we're still basically down here. And now there was an M2 money supply report that came out, and that down the road could be more inflationary. That would lead to something like this really shooting up. We don't know if that's going to happen. That's why we keep an eye on these things as well. But this is still more of an inflation-friendly environment, but it's not down to the levels that the Fed would like it to get down to. And we're getting closer. Now, after Thursday, we were actually under 4.02%. We were at 4.01% with the threat of even dropping below 4%. That's kind of acting as support right now with the 10-year yield. With Friday's downward move and interest rates going back up, we ended up settling at 4.06%. And we want to get down below that 4.02%. That's when it helps corporate profits to expand more. Above 4.02%, now they're paying what would be earnings and profits, and now they're having to pay it in interest rates. And so that's why we watch this level pretty closely. Now, this was updated after the employment report came out a week ago. A little bit of a concern here. This is long-term unemployed folks, and that has been going up lately. We just want to see if that's going to continue. This also was updated a week ago, where we're kind of leveling off with those that are usually working full time. And then FactSet just had one post because the main bulk of earnings season has now passed. And so they kind of put up a blog post maybe once a week or so, where their busy time is when we're in the middle of earnings season. But they point out here that there's a 21% decline in the number of S&P 500 earnings calls that are citing tariffs. So yeah, they're still talking about them, but it's not the big deal that it had been before. And so it's dropping off a little bit as the tariffs are working their way through the economy. So here is the intraday chart. We go back to Monday. It was kind of a sleepy day here, but we're not really falling apart. We're being able to bounce up off of some support here. And we saw a bit of an up move going into Tuesday. And then Wednesday had promise when we really started. We gapped up, but then ended up going down after that. But we did see a little bit of buying going into the close. And then Thursday is when we had a gap up and we were able to hang on to the gains during that day. I call this like a smokestack day where we have initial up thrust and then we're able to hold on to that. And then Friday ended up being pretty sleepy. We just chopped above and below the unchanged level. We did hit 6,600 to the upside, and that's about where we topped out and then drifted down from there. But we closed a little bit off of the lows, but slightly negative nonetheless. So for the week, these are the different indexes where we had the mid caps and small caps that were down for the 5 trading days. All of the other indexes ended up being positive. Going back to the beginning of the year, all of the indexes are positive, but we're seeing small caps and mid caps still lagging behind, where we have NASDAQ 100, that's growth, and the NASDAQ, and then the S&P, which is growth and value. These are the areas that have been performing well, and they continue to do so. And then we have the NYSE, that's more of a broad market measure. And then the Dow, which is not very broad, it's only 30 stocks, but it is also up on the year. Looking through the different sectors, since we had an up week, we had communication. That's the big growth area. Tech and communication, you want those to do well when you're more positive on the market. And communication did the best on a percentage basis, followed by tech. After that, actually, okay, it was positive, but it's not sorted necessarily the correct way. Then we look over here, we look at a thing called a scooter score, and that's a 0 to 100 scale. Communication is in first place, followed by tech and discretionary. When you're positive on the market, these are the three areas that you want to see doing the best, and they are right now. And then looking at the different sectors, just for the 5 trading days, we had materials, staples, healthcare. Now, staples and healthcare, they're more defensive. And then over here, you had utilities bouncing back. They ended up performing fairly well. But then tech and communication, those are the big growth areas where discretionary ended up being down slightly just for the 5 trading days. But then we go back to the beginning of the year, the defensive areas, healthcare, staples, energy, real estate. Those are still negative year to date. Discretionary has really been improving and it's looking a lot better, but it's still negative year to date. And over on the left-hand side, we have communication and tech, big growth areas that have really been leading things higher. So a lot of green overall, especially in the really big boxes here. You had Nvidia up, Microsoft up, Apple ended up being down, but they had a really good week before last with the announcements that, okay, they'll still be using Chrome for their iPhone default search engine. Then you have Google, two Googles here, Goog and Google, and both of them ended up being up. Tesla was up strong, even though Amazon was down slightly. And then down here in the lower left-hand corner, this is Oracle. My goodness. And it gave back a lot of its gains, but for the week, it ended up being up over 25.5%. So looking back at just the different sectors and how they've been performing over the last year, we're still seeing a bit of a trailing off here with tech, but that's green and that's still looking the most positive. This would be more positive if it was actually going up and to the right. It's actually coming down and to the left, but it's still one of the stronger areas overall. And what we're seeing discretionary coming on. That's the blue. That if you go back a year ago, it was about August or into September when discretionary started to lead the pack for the rest of the year. We're seeing something similar to that, at least to this point. We want to watch to see if that's going to continue. And then the industrials showing a little bit of weakness, and there's still a lot of areas that are just kind of bumping around here. Some are showing some improvement as they're turning back up, but most of them are still negative overall. And we're seeing a bit of a comeback up here with communication. That's XLC here. So looking at this more on a spreadsheet type of a way, the tech sector is still, that's looking strong, even though it's not going up and to the right, where industrials are more neutral. We still have a lot of areas. And again, this goes over the last year. It's not just the last week or the last month. This is longer term. And so a lot of these areas are still trying to recover, where we are seeing some improvement with discretionary. And we look at the indexes here, still have the S&P kind of right about at the middle. You want to be in the green upper right corner. That's the things that are strongest. Now, the NASDAQ 100 is still showing some weakness over the last year. where we're seeing the S&P 100 actually come on. Those are the large caps, and we like that in a more positive environment. We're still seeing a bit of an improvement with the small caps and the mid caps, but we need to see more follow through than what we've already seen to this point. And then we have the S&P 100, again, the really big stocks that make up the S&P 500. That's one of the stronger areas. A little bit of weakness longer term with the NASDAQ 100. Then we have the S&P composites and utilities. Those are showing some more weakness where we are improving with the mid caps, small caps, and transports. Sentiment here, the latest reading from Investors Intelligence, we're still above this 3% level. And we can go, or excuse me, not 3%, just the 3 level here. It's a ratio between bullish and bearish. And when we get above this 3 warning, that's or 3 level, that's when we see that maybe we're getting a little too exuberant, even though this line could go up a little bit higher. This is what's kind of a surprise, though. Here we are setting all-time highs, and we did multiple times this past week, and not just with the S&P, but with the NASDAQ 100. We're neutral as far as sentiment. Typically, when we're really going like gangbusters to the upside, we would see this up at the 70, 75 level, even possibly above 75. It's not there, and this could actually work in the market's favor because you've got a lot of people that don't really trust that the market's going up right now. That's why we're seeing sentiment kind of low. If it does continue to go up, they're going to like, oh my gosh, I better get in. I'm going to be left behind. I have FOMO, the fear of missing out. That, if that happens and we see a real bump up in sentiment, that might be about when the party's over, at least in the short term. And here, looking at sentiment, overall, I'm taking this more as negative because we're setting all-time highs with the S&P and we're just around the neutral area here. We should be seeing a lot higher readings than what we're seeing right now, which again could be in the market's favor. And active asset managers, a little bit of a tick up. They had gone up above 90. That was looking a little extreme. Even though they improved lately, we're still below that 90 level, coming in at 86.11. Still positive overall. And the VIX is still behaving. It's looking pretty good. We're under 20 with the line chart as well as the bar chart. But there's this typical seasonality with the VIX where it has a tendency to go up. Didn't happen in August. So far, it hasn't happened in September, but that doesn't mean it's not going to happen. And a lot of mistrust in prices going up, again, could be the reason why prices are going up. And then finally, it's like a capitulation to the upside. And then that might be about when we see some short-term top coming in. And even if we do start to pull back, at this point, it's not looking like a reversal. It would just be looking like more of a decline. Now, if it does start to show a decline, we'll just evaluate it day by day. I put out videos every day, and we'll just see if it's developing into something a little more substantial. But at this point, given what we have, if we do see declines, it's like, okay, folks have had a pretty good run. They're taking some profits, but it's not changing the overall positive picture that we're seeing. And this is still looking good here. We're going down with the black line. That means the tech sector is outperforming cash. And we did get some high readings here with the RIDEX bear bull ratio. There's still, see, again, when we're really going up, we would get a lot lower reading with this chart than what we're getting right now. There, you still have a lot of folks that mistrust what's going on. This is another thing. Individual investors, they actually are turning more bearish right now. This could work to the market's favor as well. When the market's really humming along and it's moving up like it has been, but you have individual investors trusting it and having this fear of missing out, they would be coming in with a very high reading, and that's not what we're seeing. And this kind of breaks it down a little bit here. The red line, this is the bearish percent. The white line is the bullish percent, and the red line's above the white line here, so that's why they're net bearish. And this is the spread between the two, and this is pretty much the same chart that I just showed. And then you take a 2 month average of that, and still, even in the bigger picture, individual investors are tending to be more negative than positive. But we're still pretty low here with the Ulcer Index. Not a lot of fear coming in there. Seeing the ratio between risky and not as risky bonds still quite low. That means there's not a lot of fear. And we see this in the inverted chart here. As this is going up, that means fear is coming out of the bond market. This ratio is still going down. When we look at the VIX and then a 3-month average of the VIX and do a ratio, that's positive. And we're still declining in the bigger picture here with the equity put call ratio, 253 period moving average. That's continuing to decline, which is positive. And just kind of humming along here, not really any big change with the weekly economic index, still below the black line with the Chicago National Financial Conditions Index, and still coming in above 3% with the GDP now put out by the Atlanta Fed. And that's also looking pretty healthy. 2 quarters now of positive GDP after the first quarter had been seeing negative GDP. And then the New York staff forecast here coming in at 2.28. They're starting with the new quarter here, I guess, which is this isn't the beginning of a anyway. And then this was updated a week ago. We're still below the red line here with the real-time SOM rule recession indicator. That's positive. We get concerned if it comes and goes above the red line. And not really a concern here with the smooth US recession probabilities chart. A little bit of a tick up, but still around the black line with the Brave Butters Kelly leading index. And then we did have CPI and of course PPI came out. So there's a little bit of an adjustment here coming in as those reports were released with the inflation now casting. And it's pretty much a done deal here. 93.4% thinking that the Fed's going to cut rates. Now they're at 4.25 to 4.5 right now. 93.4% of the market thinks we're going to be at 4 to 4.25, which means a 25 basis point cut after this upcoming meeting or announcement on Wednesday. And this is pretty much what the market has latched onto overall, that that's what's going to happen. Then we start looking out at the October 29th meeting, and there's 79% right now thinking that we're going to be 25 basis points even lower after that meeting. And a little bit more conviction coming in with that idea. So right now, the market's anticipating a 0.25% cut in the upcoming week, and then another 0.25% cut at the October 29th meeting. Looking at the Fed balance sheet, I just like to keep an eye on this, how it's drifting lower overall, but still on a year-over-year basis is tending to go up just to see if anything weird is happening there. We also want to keep an eye on this just to see if anything really strange is happening with the overnight reverse repurchase agreements. Not really anything all that crazy at this time. So then going through the charts here, and these are pretty much all weekly charts, we're still looking okay, even though we're flattening out with the advanced decline line based on price and volume. And coming down a little bit here, but still looking fairly healthy, a lot more green than red when we look at the new highs, new lows. Coming down a little bit with the 4-week moving average and also a little bit of a rollover with the 10-week moving average. So not showing an awful lot of robust strength, but still you can see more red than green, and that tends to be more positive. Declining a little bit, but still above zero with the advanced decline ratios. And we're still below 20. We haven't turned enough to come back up above the moving average yet to show that a trend is getting stronger. And we use the static level of 20 to show when we're below that. And there's some people that will do something different. They might use 25. I've even seen 28. I have found with the S&P 500, 20 seems to work as a pretty good measurement for if we're above 20, that means we're trending. If we're below 20, that means we're not trending. But that's a static number, and the markets are more dynamic. And that's why I put the moving average on here. When we're below the moving average, that means the trend is getting weaker. And so we're still not trending and not seeing a lot of conviction longer term. Even though the chart looks good, we're setting a series of higher highs and higher lows after coming up out of those lows last spring. So that's looking pretty healthy. But the ADX is not really picking that up at this time. But we are positive with the green line above the red line. And the Arun, which measures buyers versus sellers, we're above zero and going up with the oscillator. The green line's on top, the red line's going down. This is pretty much irrelevant now. We had a reversal signal from the mass index and it just didn't reverse. It's been just going up. And now that signal was generated a few months ago. Then this is the daily chart. We're just a little bit above this pivot point now, and we're looking pretty good. A little bit choppy here with the bar pattern, but it's for the most part a series of higher highs and higher lows, and we're holding out above this pivot point, which is right now acting as support. Then we switch over to weekly charts. This is a 50-week moving average. Price is going up, the line is going up, and price is above the line. Then a moving average crossover here with the blue line above the red line, prices above both, setting all-time highs. Then this is what I have been really focusing on now. And for 2 weeks, we are above this R1 pivot point. We spent 3 weeks getting a little bit above it, but not being able to close above it at the 64.68 level. A week ago, we closed above it, and now we've been able to stay above it for a week, and now we're starting to break above this. Now, one thing to keep in mind, and I try to point this out when I go through this chart, is other times when we hit one of these points, it's quite often that we hit it and then boom, go the other direction. Well, we've been hanging around this level for a while, and that ended up being more positive. It doesn't mean we're going to hit it and then go down. We were watching for that, and that just didn't happen. But the fact that we maintained these levels and now are starting to break above them, that's still looking more positive. The one thing is, we're not all that long ago above this level here. So if we do come down, it may not be necessarily established support. It could be, but the longer we stay above this and the longer that time goes by, if we do come down, the more likely that is to act as more genuine support. All right, we're still coming up to the upper end of the trend channel here, and we're starting to go out a little bit above it. Now, we've done that before. So we'll see if the market can continue to go above this trend channel. So we look at our smart money indicators, positive here. The weekly chart of the accumulation distribution going up above the moving average, also above the moving average with the boom indicator. That's a little shorter term. The one thing to be aware of is that we are above this red line, and sometimes that marks some kind of an exhaustion with the indicator. And we're positive with the chicken money flow. Now, we actually turned negative after Friday on the daily side, but we're still going up here on the weekly side. A little bit of a drop off with the histogram, but the red line's still going up. And going back up here, and we're actually negative on the daily side right now. We saw enough of a decline on Friday on the daily chart to drop below its moving average, but we're chopping around here. We're above the moving average, but unfortunately, we're right near this red line, which a lot of times that points to some kind of exhaustion. And we're positive with the vortex. Green line going up, but looking a little extreme. We're also extreme negative here with the vortex with the red line. That's the selling. And then we're dropping below zero a little bit here with the McClellan oscillator. So that's turning a little bit more negative. And we were improving on the daily side, but now after Friday, we're back down below zero on the daily side as well. So it's a little bit of weakness that's coming into the broader S&P 500. So we're coming down, but still above zero with the summation index based on price and volume. But you can see where we've been declining. I don't put as much weight into the weekly charts here. I tend to focus more on the daily side, but I like to look at the weekly charts just to see if they're confirming what we're seeing on the daily side. And we're declining on the daily side. So there is some confirmation here. And kind of chopping around, but we're still positive on the daily side with the bullish percent index, and we did go up. That's encouraging. And just a little bit above zero with the Swindler Trading Oscillator. We're actually seeing a bit of an improvement here based on volume as well. So that's actually looking more positive and kind of drifting down here. Now, we're trying to switch over positive on the daily side with our momentum indicators. They've just been drifting lower. Where on the weekly side here, we're still looking positive with the PMO, even though we're declining. We're above zero based on price, and we're declining with a little bit more enthusiasm based on volume. But they haven't turned negative, at least yet. So a little bit below 50 with the PMOs that are rising. We're seeing a decreasing of the buy signals to below 50, and also a little bit of a tapering off with the PMOs inside the S&P that are above zero. And we're for 2 days, even after Friday's slight decline, we're above the upper Bollinger Band on the daily side. We're not extreme here. That's what the percent B measures. The takeaway from this is that we're positive since we're above the midpoint and the midpoint is going up. So we are rolling over a bit here with the slope oscillator, but that's not confirmed by the other short-term oscillator, the TSI, True Strength Index. But when you look at the intermediate term and even the long term, they're continuing to be positive, but they're starting to get really extreme. They're well above some of these levels where we have topped out before in the past. And we're actually turning more negative here with the weekly Copic curve chart. Still positive with the force index and above 50, pulling back a little bit here with the money flow. We're actually extreme positive still on the daily side with the money flow index. and declining but still above 50 with the ultimate oscillator. Stochc RSI showing longer term positive momentum, and we're finally seeing that on the daily side too. The short term conviction is still looking positive there, and this is confirmed by a longer term look at momentum with the Stochc RSI, looking extreme. Also looking extreme with the Williams percent R. Also now seeing that on the daily side, above 50 and advancing with the RSI. We're still looking pretty good with the RSI on the daily side, and we had the up week, so we're above the midpoint here with the rate of change and turning up a little bit choppy lately, but longer term with the 50-week rate of change, that is still looking pretty positive. But we're near these red lines, so a lot of times that's where we tend to top out. But we still have some room to run anyway. And the weekly special K chart, we are continuing to be positive. We're also positive with the daily chart. I haven't adjusted this. It'll happen if we finally put in some kind of a high and start to come down. That's when these fib retracement levels will be readjusted because we're well above them. We use this chart to see, okay, we're one of these areas going to end up providing support. And since we're still going up, it hasn't really established itself yet and needed to be readjusted at least yet. But looking at the longer term trends, we're positive with the Heiken Ashi. The Kagi is positive. The Renko is positive. The three line break is positive. We did draw in a new X when we got up to 6,600 here with the S&P. Still working off of a double top breakout that was generated back on June 2nd. So the point and figure chart is still looking quite positive. And still above zero. We're hugging along just barely above zero on the daily side. We're flattening out a little bit here with the longer term ease of movement chart. And longer term momentum, still looking good, showing a little bit of improvement in the intermediate term and also an improvement with the short term. But these are still weekly charts. So even though it's short term, it's a short term weekly chart. Then continuing to be neutral though with the Elder's Impulse system. We haven't switched back over to green. It's still continuing to be blue, but we're positive with the parabolic SAR. We're also positive on the daily side. Positive, and this is shorter term, short, intermediate, and long term based on daily charts. Everything is positive across all the different indexes. Commodities, which could be a little inflationary there, positive on all time frames, where the dollar continues to be negative on all time frames. And the bonds, when we're going down with interest rates, that means we're going up with price. And so bonds are positive in the short and intermediate term. So setting a new high here with the S&P, not setting a new high with the mid caps and still lagging behind here with the small caps. Where the Dow is setting a new all-time high and looking pretty positive. NASDAQ set a closing high on Friday. That's still looking quite positive. NASDAQ 100 also setting a high and positive there. Mid caps are positive here on the weekly chart, but they haven't come back to set a new high at least yet. And we are positive with the small caps, but not back to previous highs. The NYSE is setting new highs. FANG index setting new highs. All stocks, US and international stocks, that's looking pretty solid here. And ARC is actually up, but it's been really range bound going back to over the past few months here during the summer. Not really breaking out, but it's not breaking down either, and it's still hanging on to being in an uptrend. In the bank ETF here, longer term, we're still above 50 with the RSI. The last few weeks we haven't really been moving all that much, even though we closed at the high end of the range, but the MACD is still looking positive. And then looking at seasonality or September, especially when we get to the last 2 weeks, which that's what we're going to be entering this week, those are the weakest two half a month of the year, going back to 1950. So that again, you have a lot of people that know that and may be anticipating that, which may lead to it not actually happening. We were looking for it in August and it never happened. So, but still, we want to respect what can happen as well. But usually September is not a very good month. Just going back over the last 5 years, we've only been up 40% of the time with a negative return of 3%. And then we are setting highs here with the Dow, not highs here with the transports. That's a traditional Dow theory non-confirmation. I include utilities, even though they were up on this week, they're well off of their highs that they were setting earlier on. And then we look at the broad market here. Now, commodities on the daily and weekly side just kind of ho-humming along here, and they are positive. It's longer term. When I go through the intermarket analysis video there's a long-term inflation versus deflation ratio that we look at, and it's really going up, and that's a monthly chart. But we're not really seeing all of that much carry through here on the daily side or on the weekly side. And we're drifting lower. We're getting more into the lower 60s here with oil. Copper, it's not back to where it was, but it's improving here, and it's still in an uptrend, and that is a barometer of the economy. But the dollar going down, both on the daily chart and here on the weekly chart, that's why stocks have been going up because stocks like a weaker dollar, and that's been helping. And gold breaking out here, setting new all-time highs with the gold ETF, also breaking out with silver. And we look at interest rates and bond. This is based on bond prices, where we are breaking out, not back to all-time highs here, but we are in an uptrend. And then this is a monthly chart, rolling over a little bit here, but still showing that stocks are tending to outperform bonds longer term. And this is looking at how the different maturity yields here have been falling lately. And then we look at a weekly chart internationally where we're seeing a real drop off here with US rates, but German rates haven't changed all that much. We're still keeping an eye on Japanese rates, and they're not really breaking out, but they're not breaking down either. This is what caused all the problems a year ago when the 10-year yield in Japan started to go up, and that freaked out the market. So we're just keeping that in the back of our mind. And then in our intermarket analysis chart, where gold had been just going sideways for quite a while. Now it's finally starting to break up, and it's the best performing asset, followed by stocks. And then we have bonds, that's the blue line based on price. And then purple, that's commodities. Oil and the dollar are negative year to date. Now we look at some ratios longer term. The NASDAQ 100 is now improving a bit with the S&P 500. They're both doing good. They're both setting all-time highs. But when the NASDAQ 100 is actually outperforming the S&P, because that's growth versus the S&P, which is growth and value, that's more positive. And then the S&P 100 is outperforming the rest of the S&P 500. That's positive. Growth is outperforming value. Gold coming back up here. Now, the S&P started going back up and gold has been going up, so we didn't see much of a change in this overall ratio with the gold to S&P ratio. But then the dollar continues to go down and gold is going up, so that's why we're seeing this ratio flying to the moon. And we look longer term though, bonds are still underperforming stocks on the weekly chart. And this is also positive for the market. Low volatility to the S&P 500 when this ratio is going down. That means the market is not becoming defensive, it's actually turning more offensive, and that's when it's more positive. Discretionary really improving when compared to staples. And energy continues to underperform tech, and that's what we see in a more positive environment. And small caps, now, a week ago when I did this video, it's like, oh, small caps are going to the moon. Well, they kind of slowed down right now, and they've got a lot of damage to repair if they're going to start to outperform the tech sector. Then we look at some longer term views of the market. The NYSE breadth thrust not really showing anything all that much here, not really breaking down, but not showing an awful lot of strength, even though we have the NYSE setting new all-time highs. This is the ZWAG NYSE breadth thrust. We are seeing an improvement there. Now, even if it goes above this red line, that would not be a ZWAG NYSE breadth thrust. A ZWAG NYSE breadth thrust is when we get a very low reading when the market's going in the toilet and then bounces up out of that, and then very quickly we get a real positive reading. That's not what's happening here. And we're still working off of this signal that was generated when we came up out of those lows back in April. Still looking good here with the weekly chart going back to the 1987 crash for the S&P. And this hasn't really improved. The context here is a little bit more negative because 2023, 2024, we were up at 10. Then we dropped down. We went all the way to minus 10. We came back up to 0, and now we're back down to minus 6. So you kind of have to know the context of what's been happening here. So we're not seeing an awful lot of improvement with the NYSE's Dvorak method, and that's longer term. And the NASDAQ 100 weekly chart looking pretty good there. And then the new highs, new lows for the NYSE, that's a 50 period moving average, longer term, and it's going up. That's positive. We're kind of chopping around and trying to turn back up with the 50 period moving average with the S&P new highs, new lows. And then this is still looking good here. NASDAQ 100 to Dow, that's considered growth to value. We know there are value or growth components in the Dow, but this ratio is still holding up. And we're holding up after we saw a big drop with the Qs to small caps. So that's still looking good there. And we're still tending to drop off with the 3-month yield. And then we're looking at generally improvements here with the cumulative new highs, new lows for the NASDAQ. Then seasonally, okay, I should have put the arrow over here. We're going to start coming into the second half of September now, and that's the worst performing half a month of the year going back to 1950. This also shows how September tends to be weak. This also shows the June to November period is one of the weaker times. And this is a little outdated now, but we were watching to see. I was watching this back in July. Didn't happen in July. Then we come into August, and that's typically when we see some weak seasonality. Didn't happen. We were up for the month of August. Now we're plowing our way through September, and we still have yet to see weak seasonality. But so it doesn't mean it's going to happen, but don't be surprised if it does happen. And this also shows how going back to 1950, the S&P does not perform very well. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.